the fact that what worked well in the year gone by was not just a non-India but a global investor approach, but it was also multi-asset. I mean, look what's happening with gold and silver, right?
Yeah.
Do you think one will have to keep that kind of a strategy going forward as well, for not just 1 year, but maybe next 2 years? Multi-asset, multi-economies or multi-markets?
Yeah, I think multi-asset definitely, in the sense that while gold and silver have done an incredible run, and a lot of people are wondering whether it's, it's towards the end of that. Our sense is gold is more like an insurance policy.
Sure.
Given some of the challenges in the US particularly, and some concerns around the US dollar, as well as the way their whole, monetary policy framework runs, I think it just makes sense to continue to hold gold as a bit of an insurance against some of those economics there. So to our mind, it's a great play against the dollar and should be part of the portfolio. Even though it's done a lot, I think we'd pretty much hold on or maybe even add a bit to gold if you're very underweight. Silver is a bit trickier, and silver has gone through a very rapid move, so I'm not too sure on that one. But generally speaking, real assets, commodities in particular, I think continue to do well. We've seen a big uptick in their earnings as well. And anything that is a play against the USD, I think, has a good chance of continuing to outperform for a while.
And what about global assets or global markets?
So global markets, the biggest global market is the US. That's where I would say we're a bit concerned. Valuations are high, ownership is high,
Too much concentration in
there's just
tech.
too much. So I think it becomes very vulnerable at some stage. People have been looking at other markets like Europe, China, which are doing a bit better. But again, they've also rallied a lot in the last 12 months. So right now, I would say India is pretty much in line with global markets from a relative valuation point of view. So I wouldn't expect very big divergences going forward.
So when you talk about valuation comfort, you did touch upon financials. Where else are you finding some amount of valuation cushion, given the fact that it's such a well-discovered market, that we're in right now, as opposed to what we were, say, even 7 years back?
Yeah. So Ayesha, more than valuations, I mean, of course, that's a critical point, but I think we've got to look at it under the lens of earnings, because this market has been very, very sensitive to earnings. It doesn't matter if you're cheap. If you're not delivering earnings, you will continue to remain cheap. So there's an element of wherever earnings are surprising, prices are reacting and valuations are improving. So the focus actually has to be on earnings growth. And we're seeing, this year still has been more cyclical earnings growth, which is oil and gas, metals are contributing a lot to the overall earnings growth of whatever, 10, 11% we are looking at this year. But next year, when we move to FY27, we're looking at 15% earnings growth, which is a lot more broad-based. It'll be driven by banking, it'll be driven by cement. There are more defensive sectors, less cyclical sectors also coming into the picture. And I think that, therefore, broadens the range of companies and sectors you can invest into. So I think we're looking more at the earnings angle rather than the valuation angle per se. And that's, again, it sort of still marries in with these three broad areas I mentioned: financials, telecom, and consumer discretionary, or the consumption side overall. I think a fourth area that we generally like long term, which is just buy, hold, forget type of a sector, would be pharma. I think pharma has consistently shown the ability to create value for shareholders. And they'll go through their own little ups and downs, but it's one of the best buy, hold sectors that we've experienced in India, at least.
And what's the avoid?
I think capital goods, industrials, we're just a tad, again, here's where the valuation comfort is a bit lower. They're valued already for decent growth. Any disappointment there can be a challenge. So I would say, to some extent, capital goods, industrials. IT is interesting. It's sort of already underperformed. There's a bit of a consensus that large cap IT will not do well and mid cap IT will do relatively better. I think the struggle continues on this sector a little bit. But valuations are supportive, but we have to wait for growth. Until growth comes, it's going to be a challenge.
I get that point now with the IT example.
Exactly.
Okay.
So I would say more some of the cyclical sectors is where we'd be a bit careful, barring maybe commodities as an exception.